Welcome to Behind the Deal, where we'll be exploring unscripted, candid, first-hand experiences about the wild successes and cautionary tales of professional investors, founders, consultants, and advisors as they share their stories in deal making. Thank you for joining for another episode of Behind the Deal. Today, I have the pleasure of speaking with Mr. Daniel Border, partner at Whitley Penn. Daniel, thank you for joining us today. Tell us about yourself. Tell us about the firm.
Yeah, thank you, James. I appreciate the invite to come speak today. Like James said, my name is Daniel Border. I lead the deal advisory practice here at Whitley Penn. We're part of the consulting umbrella here. Whitley Penn is a full-service CPA firm. We have audit, tax, and consulting as our three major pillars. And then within the consulting practice, there's a number of other different disciplines, including valuation, wealth management, forensics and litigation support type services, and then our client outsource accounting, which is what we call CAS. So, but my primary focus is helping buyers and sellers navigate an M&A deal.
Absolutely. And you guys are based here in good old DFW, which I love.
We are, yes. We've got 9 offices throughout pretty much all the major metro areas in Texas. And we got one small office in Hobbs, New Mexico.
That's right. I forgot about that. That's right. Well, it's great to have you here. I always love chatting with you. So we were talking a little bit before, and you've got a couple stories, but I think we're going to go into both of those here. So you have the floor, sir. Tell me a story.
Yeah, absolutely. My primary focus is financial due diligence, helping our clients, whether they're a buyer or a seller, kind of navigate the nuances that are present within a target company's financial statements to better communicate those to the opposing parties, or to illustrate, certain flat spots that might be present, and then ultimately try to uncover, mitigating factors or kind of what the risk profile of the deal ultimately looks like. And so in an M&A transaction, you have your purchase price, and in the world that I work in, the purchase price is typically derived as a multiple of adjusted EBITDA. So earnings before interest, taxes, depreciation, and amortization. And it's adjusted for any sort of one-time items that won't be present post-transaction. So that's the work that we do in a quality of earnings analysis, is try to find those items, calculate them, make sure that they're communicated appropriately to all the constituents within the transaction. But there's another economic piece to a deal that oftentimes gets glossed over, and there's not a whole lot of focus on it, and that's the working capital within a deal. In most of the transactions that we work on, a company is going to have to deliver a certain amount of working capital in order to sustain operations going forward. And the way that most people will do that is they will look at trends over time to determine what is an appropriate target number that needs to be delivered.
What is the working capital? What does that mean?
Yeah, so that's the academic definition is it's current assets less your current liabilities. Now, for a transaction, most of the deals that we work on are done on a cash-free, debt-free basis. So you're going to take out all of your cash, you're going to take out all of the debt or current portion of your debt, and what's left is your current assets less your current liabilities for purposes of a transaction. Then we're also going to look at any sort of assets or liabilities that are not going to provide economic value or economic liability to the buyer in the transaction. So we're going to want to pull those things out as well. Say, for example, there's an accounts receivable loan that maybe the business owner loaned the company, a certain amount of money, and that's sitting as an accounts receivable on the balance sheet. Well, that's really just a placeholder, as the business owner might not necessarily be looking to collect that anytime soon, but that's not going to provide economic value to the buyer in the transaction. So we're going to remove that accounts receivable as a result of the transaction.
Makes sense.
So those are types of things that we would be looking for in our working capital analysis.
Okay.
So when we're analyzing working capital, like I said, we're going to look at trends over time, and we're going to try and understand, okay, what does the company actually need in order to sustain operations? Working capital can be different for many different companies within the same industry. And the reason why that can be different is it's based upon, the operator or the business owner's own risk profile. So if they are very conservative, they're typically going to want to leave a lot of working capital in the business in order to just, have their rainy day fund just in case something were to happen.
Right.
Now, if they're a little bit more aggressive, maybe that business owner is stripping out working capital and taking dividends and such and keeping a lower amount on the balance sheet. And that might be cause for concern going forward, where, maybe the company is a little anemic and is stunted with its growth because of a lack of working capital available to them. So in a transaction, when we come in and we look at it and we say, okay, well, here is an average over time. Typically it'd be like 12 months. We would say, take adjusted working capital, average it over over the previous 12 months. Let's just say, for argument's purposes, in this particular deal that I am talking about, that number ends up being $10 million. But in this particular deal, when you looked at just the face of the income statement, in the face of the balance sheet, and you calculate what's on there, he was carrying about $20 million worth of working capital. So he had about an elevated amount of cash. He had an elevated amount of accounts receivable, and he also didn't have very many payables. So, he had a ton of cash on the balance sheet, and he used that, as kind of his operating fund. Now, you may ask, well, Daniel, you told me earlier that transactions are done on a cash-free, debt-free basis. Why does it matter that he had so much cash? He's just going to keep that cash anyway at the end of the day, right?
Yeah.
That's correct. But what this ended up doing for him was the way he operated his business was he was not very focused on the amount of working capital that he was carrying. So when you looked at his aged accounts receivables, the average age was around 75 days. So
Meaning he hasn't collected in that amount of time.
Exactly. Yep. So he would invoice it, and then he would typically, on average, collect within 75 days.
Wow. What kind of business or what industry was this in?
It was a services business. So he went into retail companies and did a lot of maintenance around the buildings.
Okay. Wow.
So
he's around 75 days in collection,
and he had a lot of very, very well-known customers. It was just one of the things was like, as he would bring on a customer, he would befriend his contacts over there, and he was like, I have enough sitting in my checking account here that I don't necessarily need to bug them to collect that money. So I would rather make them happy by not bugging them than, create some friction there that could erode the relationship longer term.
wow.
So totally
Altruistic.
get that, make that.
Yeah.
Then on the flip side, when you look at his payables, he had a days payable outstanding of about 5 days. So to your question earlier, what that means is that when he gets an invoice from one of his vendors, he's typically paying that within 5 days. So
Not the usual 30. Not the usual 30, right?
Not the usual 30. Exactly. Yeah. So what that meant was, his cash conversion cycle was huge. It was taking him a long time to convert revenue into cash. And so when we came in and we did our analysis, we said, look, going forward under new ownership, we're probably going to need to be a little bit more disciplined with collecting the AR, and we'll probably have to be a little bit more disciplined in paying our vendors in the appropriate amount of time. There should be no reason why you should be spending, money to pay a vendor 25 days early. Keep that cash for yourself for operating purposes, or just accrue that 25 days worth of interest that you could potentially get.
Yeah.
So what we did is we performed this analysis and we said, okay, at the beginning of the period, and we look back and say, okay, over the last 12 months, average working capital was about $20 million. Now let's put in place some certain policies and procedures, collecting on time and paying our vendors in an appropriate amount of time. So given that we had a little bit of a runway here before the company actually sold, it's actually about 16 months from the point in which we were initially engaged and did this analysis to when they actually sold. We were able to work with the company to whittle down that working capital to a level that made a lot more sense for the actual business need. The company was doing about $80 million a year in revenue. And so by the time we had completed our work and we were getting close to closing, the working capital was now whittled down from 20 million to about 10 million. So that's real dollars now that the seller got to keep for himself, as
Wow.
opposed to having to deliver that to the buyer in the transaction.
Wow.
So
So, well, I was going to say that. So, $10 million is what he was able to keep.
so that was the savings that he got as a result of the analyses that we performed, and also talking with the buyer about, look, the seller has chosen to keep an excess amount of working capital on the financial statements, on the balance sheet. Here's why he does it. There's no significant business need, though, to carry that much working capital. So we were able to show the seller that over time we whittled it down, and there was no change in customer relationships. There was no change in or decline in revenue, and everything. There was no issues with vendors or anything like that. So we were able to illustrate that, yeah, this was really just because the business owner seller was just very conservative with his fiscal policy.
Yeah.
So that's one side of the equation here. And the other side of the equation was there were certain EBITDA adjustments that we had come up with, and we had determined that EBITDA was understated by about $2 million. And so when we were looking at these types of adjustments, these were things that were hitting the P&L as like personal expenses or expenses that would not be continuing post transaction, putting them into a bucket, gathering documentation to help support those numbers, and then ultimately presenting them to the buyer to say, look, this $20,000 a year hunting lease that he has, the business isn't going to pay for that going forward. So we're going to add that back to EBITDA.
Oh, yeah. Okay. And that
So
helps with valuation.
exactly, because like I said earlier, the valuation is based off of a multiple of adjusted EBITDA. So in this particular instance, the multiple was 8. EBITDA originally was about $10 million, so 80 million. Now we're saying, okay, no, it's more like $12 million. So 12 times 8 is 96. So it went from 80 million to 96 million.
Wow.
So
$16
that,
million difference.
yeah, $16 million there, plus the $10 million in working capital savings. So the overall economic benefit to this particular client was about $26 million, just by hiring us and going through the process of truly understanding what's driving the economics of the business. What do the metrics actually say? Does it make sense? And if they don't make sense, what needs to change in order for it to make sense?
That is incredible. I mean, that's what, roughly a 25% difference.
Yeah, it was a great outcome all overall. Client was thrilled, and at the end of the day, it adds to the credibility of doing a thorough quality of earnings analysis and hiring proper consultants that are going to not just give you the numbers but tell you the why behind the numbers, and
Yep.
what's at risk, or what are the benefits to the findings that are in a quality of earnings analysis.
That's incredible. I mean, I think I said this earlier. I mean, who doesn't want, an extra 16 to $20 million in their account? You know what I mean?
Exactly. But a lot
That's
of owners don't necessarily understand the value proposition at the beginning when they
Yeah.
start when they start talking to me about, why should I get a quality of earnings analysis, and I tell them, like, it's going to help you better articulate the earnings trajectory or the repeatable cash flows of the business, they oftentimes don't correlate that with the end result value proposition that we do bring to the table. And look,
Yep.
James, there are definitely times in which we come in and we say, you know what, you think your EBITDA is $10 million. Through the work that we did, it's actually only $7 million.
Yeah.
Now, the business owner knows, well, I'm not going to get 10 times my multiple for it. Or sorry, I'm not going to get 10 million times my multiple for it. I'm going to get 7 million times my multiple for it. And expectations can then be better adjusted.
Yep.
So that, you don't get to the 11th hour and the buyer comes back and tries to retrade it. You already have set a foundation for understanding and given the business owner the leverage in order to properly communicate what's going on with his business.
Yep. And I think you have another story somewhat related to that, I
I
think.
do. That's right. Yeah. So, it's kind of related to working capital again. So, like I said, you're gonna, in a transaction, you're gonna come up with a target number and say, okay, this is what we're ultimately going to be contractually obligated to deliver at the time of closing. Then post closing, go in and you true up that number. You do an analysis and say, okay, well, what was actually delivered? You do that 90 to 120 days later, so that you can make sure that you get all the proper transactions entered into the accounting system, and any sort of vendor invoices or something that might come in post transaction that relate to stuff that's pre transaction. So in this particular instance, there was a lot of noise going on in the balance sheet within the current assets and current liabilities, and there were a lot of adjustments that we had to make in order to properly determine what a necessary working capital need was for the business. So in this particular situation, we went through and we said, okay, here's what's going on with AR, here's what's going on with inventory, here's what's going on with your prepaid assets, your accrued liabilities, your accounts payable, so on and so forth. And in the purchase agreement, given that we had done such a thorough job of analyzing working capital, we wrote specific policies around how those accounts should be calculated post-transaction for purposes of the true-up. So we were very, very specific. And we had about 25 different bullet points talking about working capital, what has hierarchy above anything else. And all of those points were ultimately negotiated with the buyer. But at the end of the day, we closed to a particular number. Our target was $14 million. We closed the transaction. And then 90 days later, the buyer did their analysis and they said, you know what, Mr. Seller, you actually delivered $180,000 more than the target. So what that means is that we owe you $180,000 to true that up.
Not too bad.
Not too bad. Yeah, exactly. And a lot of people would be like, okay, yeah, that makes sense. Let's go ahead and accept that and move on. Like I'm getting a nice, additional $180,000. Cool.
Mm-hmm. Mm-hmm.
But the problem was when the seller gave us the analysis that the buyer did, there was a lot of inconsistencies around how the final number was calculated and how we calculated the target. They did not follow all of those bullet points that we had laid out in the purchase agreement.
Oh boy, here we go.
Exactly. So, there was about 5 or 6 areas that we were saying, look, this is inconsistent with how the target was derived and the language in the purchase agreement. So what had happened is we then went through when we recalculated the numbers based off of the language in the purchase agreement, and we said, no, buyer, you don't owe them $180,000. You actually owe them $1 million. So you have, $820,000 delta there.
Yeah, that's pretty healthy difference.
Exactly. Now, to your point earlier, a lot of sellers would have just been like, okay, I'm getting 180 grand. That's great. But would you rather get $1 million than 180.
Right, right.
The language in the purchase agreement.
Yeah.
So in this particular instance, there was some negotiations back and forth, and at the end of the day, they settled on $750,000 as the final number. I disagreed with that. I still thought the number was a million, but in order
Sure.
to make the parties happy and everybody can go on their merry way, they settled on $750,000. But that's where a lot of disagreements do come in post transaction, and it really boils down to the fact that they did not have a thorough working capital analysis done during the diligence process, and they also did not put proper language in the purchase agreement about how those accounts will be calculated post transaction. If you don't do that, that's just going to create a lot of ambiguity at the end of the day, the end of the transaction, and you're truing it up. And then, you're saying, well, this is what we thought we were doing. Well, what you thought you were doing doesn't matter. What's in the purchase agreement matters.
Do you was the buyer's analysis conducted by themselves, or was this a firm that they outsourced it to? Do you remember?
They had a representative that they were using to help them with the calculation. Yes.
Okay, interesting. So,
That,
so was this? Do you remember? And you don't necessarily have to say names, but was this another firm similar to yours, like another accounting firm, or
it,
was it? Do you
it
remember?
was. It was a firm that's quite a bit larger than us,
Hmm.
but they. I believe they felt like that they had certain areas that they could maybe skirt the rules a little bit, or maybe
Yeah.
gloss over the language in the purchase agreement, or use
Huh.
2020 hindsight post transaction to apply to the period way before close.
Interesting.
So it was interesting how the arguments that they did ultimately come up with, just it was just very inconsistent with the actual language in the purchase agreement. So I'm very
Wow.
thankful that we pushed to have a very detailed list of accounting policies and procedures related to working capital.
When it comes to that kind of stuff, I mean, where do the attorneys fall into that? I mean, how does that kind of impact the situation, or in this case, how did it impact the situation, if at all?
Yeah, I mean, they were heavily involved in the negotiation back and forth. We worked alongside the seller's counsel and attorney. Again, just making sure that we, truly understood the specific language that's in the purchase agreement. As in any sort of business contract, one word can really modify the meaning of a whole paragraph, right? And
Completely, yes.
so, as we're going through and we are, analyzing this in meticulous detail to make sure again that, hey, this is what it says. This was the meaning behind it. And yes, that is consistent with how we calculated the target working capital in the diligence. So yes, the attorneys were heavily involved in this process, and they helped us kind of craft the language around our rebuttal at the end of the day, so that the counterparties on the other side could better understand our positions.
What was the industry in this one?
This also was in the services space. They did more industrial services though, so they had um, their clients would be large Fortune 500
Okay,
companies that may have had like a catastrophe at one of their facilities or something like that, and they came in and kind of helped mitigate or deal with a lot of the issues that might be present as a result of those catastrophes.
wow. So one of the takeaways I have from that second story is immediately is bigger firm is not always better. You
Exactly.
know, I
Exactly.
mean,
Yes.
yeah, the buyer side had a larger firm than what you guys are, and didn't quite work out for them so well. I'll say. I
And
think.
I'm going to have to say it too. I mean, the fees that the buyer paid that firm were astronomically higher than the fees that my client paid us. So,
Yeah, yeah,
at the end of the day, it's like, well, did you really get value for those fees? I mean,
yeah.
it's hard to say.
I would say not that much on that one,
Well, let's
unfortunately
say
for them.
that.
Yeah, no, I mean, but I think another major lesson out of it though too is kind of like we were talking about earlier, is doing a quality of earnings and having advisors like yourself that are helping with the transaction. I've met a few folks in my time that they basically sell their company on their own,
Right.
or they might be buying them by themselves, and it's like I would really not do that kind of stuff, especially when you get into the multi millions. Like I would not do that alone. It's just
Absolutely.
and I've never
Absolutely.
heard, and
Getting
of
into, yeah,
those folks that of those folks I've met, it's never a good story that they
right.
have. It's
Right.
always a horror story. It's like, oh man, I'll never do that again. It's like, I hope not. That's why there's entire industries and firms and slews of advisors that do this kind of thing every single day. And it's like, why would you not just hire one of them? you
Absolutely.
know,
Absolutely.
but
The buyer is going to hire an accounting firm to do the quality of earnings or due diligence. They're going to hire competent attorneys. They may even have a buy side advisor, investment banker out there that's, advising them on the structure of the deal or found the deal for them. Why shouldn't the seller have the exact same ammunition in their gun to ultimately negotiate from a position of strength where they
yes,
have the exact same information available to them?
yep,
Um, this is to your point. There have been many people that have executed a transaction on their own, but I can almost guarantee you the economics of those deals would be lower post fees that they pay their advisor had they hired somebody to help them through it.
I'm certain of it. Man, I appreciate these two stories, and there's a lot of insight there. Thank you, Daniel. For those that are watching, I hope that you got as much use out of this as I do. I think um, it goes without saying that you need to hire professionals to help you with your deals, and not only that, you need to make sure you're hiring the right ones that are not always just the largest to pick from. But yeah, I think lots of lessons there. Daniel, thank you for your time. Thank you for the stories, the insights. I greatly appreciate it, man. You're heroic, saving people millions of dollars, making them millions as well. I'm going to keep that in mind for myself. But thank you very much again.
Thank you, James. Take care.